Hi everyone, this is Rob Roy and welcome to the Elliott Wave Options U.S. Market Update. As we do each and every week, we show you on the screen the stocks will be featured in this recording. And if there's a particular stock you're interested in, you go directly to it using the chapters feature on this recording. Got a lot to talk to you about this week, obviously, with what's been going on. So I'm going to talk rather fast. First and foremost, let's get to the chart of the S&P. When we take a look at the chart of the S&P, if you've been watching these recordings over the past couple of weeks, you know that we've been talking about this zigzag pattern that's in place. In the past, I mentioned that if you move this Elliott Wave algorithm back to looking at just 100 points, we had a wave 3, but now we don't have to do that anymore. The wave 3 has been labeled in the longer time frame of 377 data points. So again, you're just telling the algorithm how many days to look at because this is an end of day chart. And just as a quick reminder, if you haven't been following us, here's what we posted in the thumbnail 2 weeks ago, where we talked about how we were going to get a bit of a bounce in this zigzag and be ready to sell because following the bounce, we're going to move to the downside. And that's exactly what happened. We moved lower. We had a target of 5,400 on the S&P or 540 on the SPY. And we went exactly there. Some of you had actually commented that, oh gosh, I don't think we're going to see 540, or I hope we don't see 540. Well, we did. That's where we closed yesterday. Look at that. So we switch back over to the chart of the SPY. There's where we closed yesterday, right on the 61.8% extension, right at 540. But the market wasn't done there. We were a little bit oversold. You can see it's a pretty vertical move. You've heard my rules. Nothing goes vertically very long. What goes vertically up or down usually retraces and goes vertically back to the upside. I thought that we had the possibility. That's the way zigzags work. We had roughly a 38.2% B wave correction, which was going to yield that 61.8% target. That's where the 540 on the SPY or 5,400 on the S&P came from. And we always have the opportunity of moving to an extended C wave, which is the 100% extension. I didn't necessarily think that was going to happen in one day, but it did. So right down to the 100% extension here. And as you can see from the 10-day moving average, we are a bit oversold here from where we've been. But gosh, pat on the back, victory lap. We nailed this one, and you've seen it. It's been published on the thumbnails, and so we caught this zigzag spot on. So we're at the 100%. So it's an extended C wave, not just the target, but the extended C wave on this 5-wave pattern. And we do have the wave 3 labeled on the longer time frame of 377 data points, which I use. You can change it in the software. I use 377 because it's in the Fibonacci summation series. Something else that I thought you might be interested in that our data scientists look at is they look at the macros in the market. So we're going to show you a chart. This is right from the data scientists at hubb.com. If you haven't gone and gotten a copy of this software, I don't know what you're waiting on now, especially with what's occurred over the past couple of weeks where we've nailed this. You can go get a free copy of the software. You get free Elliott Wave. You get free intraday Elliott Wave. But those same data scientists utilize the charts here of the macroeconomics. And if you look in the upper left-hand side, you can see the red line is contraction. And when we see that we move from green to red, going all the way back to 2015, when you look at where we turn from green to red, we go through a period of sideways movement in the markets. Then we go back to green. That represents expansion in the economy, and we go for a rally. Now the yellow is slowdown. So there was a time there in 2019 that we had slowdown. And then we went back to green, then we go back to red, so full-on contraction in the economy, and that was COVID. There's that big move to the downside that occurred in COVID. And then we had the big rally. We went through a little bit of contraction before we had this final move. But notice in this move, we've gone directly red. So we've gone straight from expansion to contraction in the economy. We've been talking about how the economy is pulling back. It's not horrible, but it's been pulling back. And we all know how important liquidity is to the market. And a lot of you have been commenting, rightly so, about the Fed and their influence on the markets from a liquidity standpoint. So I'm going to show you a chart of the Fed liquidity. And this goes all the way back to 2007. If you remember, in 2008, we had the great financial crisis and the Fed injected tons of liquidity. That's the blue line. The black line represents the SPX. And so they put all this liquidity in, and that spurred a rally in the market. They kind of started to pull some out, and we moved to the downside. Then we had COVID, where they threw the kitchen sink at everything, put a whole bunch more liquidity in, and that spurred this last rally. But notice, like, once again, liquidity went sideways, dried up a little bit, and that's where we are now. So we're getting this pullback in the markets because the Fed hasn't been injecting liquidity. Now we can zero in on this chart a little bit more and move it into just the last few years. And so you can see this is going back to post-COVID. There's that spike in COVID. So again, the blue line is liquidity. I just think this is an amazing chart to look at. So we go through here and you can see there's the S&P. We've pulled back, but behind the scenes, this is really key here. Behind the scenes, the Fed has been injecting liquidity. Everybody thinks they've been withdrawing liquidity. No, they've silently been injecting liquidity. So the point of that is that we're getting pretty close to the point where Fed injection of liquidity is meeting where we are in the S&P. So I do think we're near the bottom here on this correction that's occurred in the market. I think that's really important. And as you all know, if you've been watching week after week, we've been talking about how we've been giving away one of our free level 3 subscriptions each and every month. We did it last year. We're doing it this year, but we're going to up the ante this week just to celebrate just being spot on with this zigzag pattern to the downside. We're going to offer all of you a free month of our AI impulse-based strategy. The impulse-based strategy is the directional strategy. It's basically trading zigzags within the wave 3. And if you click on the link that's provided in this recording and underneath this video, it will take you to a landing page that looks exactly like what you see on your screen right now. Notice there's no place for your credit card information in there. We have to have your email address so that we can send you out the alerts, but we're not asking for your credit card information. So this isn't one of those, oh, this is a free offer. You get 30 days free and then we charge your card. No, we're not doing that. This is completely unrestricted, free 30 days access. Well, you'll get all the AI alerts that come out in our impulse-based or directional strategy. And then at the end of the 30 days, if you like it, you can send out a message to our support staff, and one of our account services people will get in touch with you and get you the best deal that we have at that point in time. So I just wanted to reiterate, this is not one of those schemes where, oh, you get 30 days free, but then your credit card's charged. We don't even want your credit card. We're not even asking for it. Just give it a try. See what you think. Kick the tires. You have absolutely nothing to lose by doing this. All right, so let's go back to the chart of the S&P. And so this is where we finished on the daily chart. I think it's important at this point in time to go ahead and look at the weekly chart. So we'll change the S&P over to the weekly side of things. And you can see that on this movement today, we've moved down for this week. Week's closed now. It's Friday, right near the 50% corrective level. We haven't gotten quite there, but notice how separated we are from the 10-day moving average on a weekly chart. And if you go back and look, you can see how all these weeks just follow that 10-day moving average. That same rule I talk about, no security any time frame gets too far from the 10-day moving average. So I showed you the liquidity chart where the Fed is actually behind the scenes injecting liquidity, and with this big move to the downside, we're quite oversold in the market. So I do think we're pretty near at least a tradable bottom. I don't know for sure if this is going to be the end of the move. It might be. I'm going to switch back to the daily chart, and looking at that, you can see that we could hold at this 100% extension. And once again, there's the 10-day moving average on the daily chart showing that we are quite a bit oversold with this vertical move. As I said, moving to the extended level is quite likely. Just didn't necessarily think it was going to happen in one day. And President Trump announced today on the tariffs that Vietnam, which was one of the surprises on the tariffs that were announced after the close on Wednesday, that their tariff was a bit higher than expected. And they said they want to bring the tariffs down to zero. So they want to negotiate, which is what this tariff thing has always been, in my opinion, is a negotiating tool. And the market tried to rally at that point, but then it gave it up. And we closed down here near the low of the day once again on Friday's trade. So I know a lot of this market downward move has been blamed on the tariffs, but I really think that the tariffs were kind of an excuse for people to sell. We knew we were overbought, and this is what happens when the market gets to the point where multiples are high and we're overbought. The weekends look for a place to sell, and that's what's been occurring. Granted, the tariffs were a little bit stronger than expected. There had been some whispers that maybe they'd be a little bit lighter than expected, and the market tried to rally up on that. But I really think this is more or less just an excuse to sell, especially when clearly, based on President Trump's comments today, this whole tariff thing has been a negotiating ploy. All right, so that wraps up the S&P. Let's go look at the VIX real quick. And when we take a look at the chart of the VIX, I had talked about this last night in our insiders meeting where we had the VIX up around 30, and was that a high enough spike in order to put in a bottom? And my commentary had been, and if you do sign up for the 30 days free trial, you'll be able to access those insiders meetings for subscribers every Thursday night. We do those. I mentioned that I would much rather have seen the VIX spike all the way up to 50. Well, we didn't quite get to 50, but we got up to 45 today. So that's where the VIX went. Now we're getting to the point where that's a high enough spike. And we go back to the chart of the S&P, and we're right at the 100% extension on this zigzag pattern, which played out exactly as we talked about, as you know by now. I think that maybe we can get some sort of at least a tradable bounce at the beginning of next week, and we'll have to wait and see if we're going to go further from there. I do want to move to the bond market rather quickly. We'll go over to TLT because, gosh, that's been interesting. We've had this breakout to the upside. We had a false downside breakout of the triangle, and if you remember, this TLT chart, which is prices on the 20-year. Remember, prices and yields move inversely. This is the prices on the 20-year. We had this wave 5 down, which was as about a classic of Elliott Wave as you can. Go back and look at the previous recordings if you want more information along those lines. And then we went through these two twin consolidating triangles. We had a false breakout here to the downside, but prices on the 20-year have been going up. So prices have been going up, yields have been going down, and you would think that could help put a bid under the market. But I think you have to realize what's causing the bid in the bond market. And at this point in time, clearly looks like a flight to safety. Money's leaving the equities market, moving into the bond market. So prices go up, yields and rates go down. But over on the longer term, that could be helpful. When we go to the Fed Fund futures, the Fed Fund futures are now pricing in a 100% chance of a rate cut in May. I think that's a little bit aggressive, but the Fed Fund futures, when they get above 85%, have a great track record. And when you have 100% reading on there, the Fed is going to take a look at that. I mean, the jobs report numbers, the JOLTS report wasn't bad. And then we had the non-farm payrolls today, which wasn't bad either. It was actually pretty darn good. And the Fed has said the one thing that could get them off the couch to cut rates a little sooner would be if the bond market weakened, or excuse me, if the jobs market weakened, but it hasn't. So I don't know. You go by the Fed Fund futures with their track record on a May cut. I don't think the Fed looks at the stock market, but we're going to wait and see. There was some hawkish commentary today saying that basically they didn't think they were going to do anything, but some people think that they are. And then when we look at a TNX, I know you guys like to look at that. That's rates on the 10-year. You can see rates have been moving down significantly. So the 20-year shows prices up, yields and rates down. They move in concert. And we've had some lower rates than we've had in quite some time. At some point in time, that will matter to the equities market. So again, I think maybe we're at a point where we've had a little bit of washout selling, and we'll see if we move higher. I like the fact that the VIX spiked a bit higher today, as I mentioned. Let's look at some of the other U.S. markets. We'll go to the Dow. You're going to see a lot of charts that are quite similar here. We move to the downside here, also right to the 100% extension on the zigzag. Now, this was more telegraphed. If you remember, the zigzag, the B wave, was more toward the 38.2% level on the SPY. which gave you the 61.8% target. But here on the Dow, we went right to a 50% correction, which does yield that 100% extension, which is exactly where we went to on the Dow today. So for those of you who've been questioning zigzags within the wave 3, I don't know what I can do to show you that they work. And trading them within a wave 3 is a way to figure out where a wave 3 is going to end, the strongest of all the Elliott Wave patterns. Just been absolutely spot on. Let's go to the Qs because my goodness, you would think that, holy cow, with the rates going down, maybe the Qs wouldn't act so bad. But we've come all the way down. We had this first support level at 450. We broke below that. The next level of support was down here at 425. And that's exactly where we went today. So a little bit oversold on the Qs in this wave 3. And I haven't labeled this, but we do have a zigzag here within the Qs as well, right to the 38.2% level. So we've already hit the extended C wave target. So 61.8 would have been where you expected. Again, where we closed yesterday, just like on the SPY, although you could argue this is even purer on the Qs, down here to the 100% extension. And looking at the IWM, and this is the one that has a little bit of push and pull. You have the small caps, which are viewed as a little bit riskier, so risk on, risk off type of thing, but they're also very interest rate sensitive. So rates coming down, maybe we can hold in there a little bit better on the IWM, but nope, it's succumbing more to the risk side of things, where we've gone all the way to the 161.8% extension with a 50% B wave correction. You go to 100% extension. So we tried to hold there and we didn't. So then you go down to the next fib level. So you can see all these markets, every single one of them is right at a zigzag within the wave 3. So that's the one agreement on all the markets, is that we are at an extended C wave level on the wave 3. Once again, I think a point where maybe we can look for at least an oversold bounce, if nothing else, sometime in the beginning of next week. It might not happen at the open on Monday, but at some point in early trading next week, I think we get a little bit of a bounce. So let's go ahead and move into the metals. We'll look at gold, which even gold has taken a little bit of a break. Do think that gold eventually hits 300. Talked about that tractor beam effect, the nod to my dad from the whole Star Trek days. When you go towards these big numbers, they tend to just draw you in there. But we've had just one heck of a run on gold, specifically GLD, from this triangle that occurred back here in January. So we had this nice run, formed another little triangle, took off again. Classic stuff with the GLD, right up to the 100% extension level. And then we pulled back just a little bit. But note, even on GLD, we finished off the lows of the day. Not such the same thing when we go to silver. We go to silver and you can see that, oh boy, this was an ugly day. But we had a strangle on SLV, which meant we didn't care if we broke to the upside, which it looked like we're going to have an upside breakout. We didn't get to the point where the strangle was profitable. And then we get the reverse down to the downside. So we took that off today, took a nice gain on that strangle. We're getting to a point of support here on SLV. Also the wave 5 low from back in January, where we had this extension from the previous 5-wave impulse pattern. Maybe we close that out a little bit early, but we did hit the low of the day. But we could go a little bit lower on SLV. But once again, it's a nice trade. And you take your profits when you can have them. You also get an IV induction here. And as a subscriber, if you sign up for that free trial, you'll get access to the education area. And we talk about all this stuff. We really pride ourselves on the education that we offer at ewotrader.com. So that's the metals. Let's go ahead and go into the cryptos. And gosh, if you talk to crypto experts, they will say that there's no direct correlation between the crypto market and the equities market. But I have noticed that in the past, if we were in a real strong risk-on environment in equities, it seemed to put a bid under cryptos. But if we're in a real strong risk-off, it seemed to sell things off. Not this time. Crypto has held in pretty darn well. That's exactly where we are with Bitcoin at this point in time. So with an ugly tape for the past 2 days in the equities market, crypto stayed pretty strong. And maybe that has to do with the dollar. So before I go to the rest of the cryptos, I'm going to jump over to the dollar. we had this big move to the downside. Remember, I've been talking about how I didn't want the dollar to stay so strong. I wanted it to be in this 100 to 104 relationship. We did get a little bit of a bounce back up, so we're more right there in the US dollar. That's a good place to be. Trading between this 100 and 104 level. That's where we want the dollar to be. I think that's the sweet spot, the Goldilocks spot, if you will, where the dollar remains strong. We don't want to lose the dollar completely, but it doesn't get to the point where it's so high that it hurts internationally traded companies. We have a global economy now on the exchange rate. So pretty happy with how the dollar has been acting. Let's go back to the cryptos in Ethereum. Even with the moves in Bitcoin that have been stable, we're still kind of just trickling down here on Ethereum. It does seem like Ethereum wants to see 1,500 at this support level before we're done with this wave 3. Maybe that will be a point where some sort of a bid comes into Ethereum. It's just been like the kiss of death I've talked about in the past couple of recordings on Ethereum. Everybody wants to look at XRP, so we go there. And we did get a little bit of a bounce today. I know cryptos trade 24/7. I understand that, but they also have a calendar rollover so that if you're looking at an end-of-day chart like this is, remember, you can look at the live charts, but this is the end-of-day chart showing a little bit of a bounce, but only back to the 10-day moving average. So it's nice that we didn't have a worse day or a worse couple of days in the crypto space, but we're far from out of the woods yet as far as generating a bid on the cryptos to move up. Solana is one of the ones that you like. And we have this ascending triangle that we've broken to the downside. Seems like we do want to come down and test support down here on Solana. Maybe we can hold this first level, but we've got this corridor here. We've been trying to hold this area. We broke below it. We tested it today, but maybe we need to move down to the next level on Solana. And then Cardano, which is the one, as a reminder, that was a surprise to everybody to be included in the strategic reserve basket. We had that 60% one-day move right back down. But we have this corridor support here, very similar to what we just showed in Solana on Cardano. But boy, Cardano needs to hold this 60% level. If we don't, then we might be facing one of those Katie bar the door scenarios where if we can't hold here at 60 cents, we might be looking at a move all the way back to the pre-election day bump that we got in all cryptos, back down towards that 25 or 30 cent level. So really key that Cardano holds right in here around 60 cents. There is nothing to hold it from 60 cents back down to 25. So we need to hold this level right here. And even on the high, we weren't able to take out the 10-day moving average. So things to keep an eye on there as well. All right, let's move over to energy. Gosh, in energy, we've been talking so much about UNG on our Tuesday TradeFinder events. We've been looking for so long for this bid under UNG, and we finally got it with the fact that all these data centers are going to be running on natural gas. So we got the bid. We had a wave 4 that came down right here towards that 50-day moving average and a 38.2% level. We tried to bounce off of it. We got back above the 10-day moving average yesterday, but back down to test it here. So again, talking about TradeFinder, we do that every Tuesday at 1 p.m. Eastern time. If you're not a member of TradeFinder, you can see the link on your screen. You can sign up for there. It's also free. We talk to markets. We look for trade ideas, and we have a live Q&A. It's a great community. Ask great questions. They interact with each other, and you can interact with other people from TradeFinder. So good community, social media aspect. We also feature the social media aspect of the software on Tuesdays. So lots of great things to be part of. So if you haven't signed up for TradeFinder, go ahead and do it now. And we look forward to having you in next week's session on Tuesday at 1 p.m. Eastern time. So during the markets, once again, it's free. So back to the chart of UNG. We have to wait and see if we can hold this wave 4 low. The algorithm has it green, which means the wave 4 is still active. In other words, the algorithm is not sure that this wave 4 is done. Even though we bounced off this level with the 50-day moving average and a 38.2% fib level, we could go lower on the wave 4 because the questions are coming in now regarding natural gas. All right, how many of these data centers are going to be built? And how much natural gas are they going to use? How long is it going to take to build them? All those kind of questions are coming out and creating, oh, okay, well, we put a little bit under natural gas, but maybe we need some more information before we turn and go higher. Oil, woo! Oil has come back down. Boy, that's going to feel good at the gas pump when that's reflected over the next few weeks at least. I talked about this trading range. We had this triangle right smack in the middle of this range between, call it 65 and 80, and we started to creep up. So I wouldn't be surprised if we tested the high, or wouldn't be surprised if we tested the low. Didn't think we were going to move up towards the high and down to the low at the exact same time or a couple days later, but we are testing this low level here. But I still think that OPEC will come out if we start to trade a little bit below this. They're going to come out and cut production. So we've tested this level. You can see we closed near the high of the day on oil. So we did have the breakdown, opened here, traded below it, and then came back above it. I still think this is the range that we're going to stay in oil throughout the rest of the year. I think that all plays out, but we'll talk more about that stuff each and every week. As far as well as international markets that we talk about during TradeFinder. So please join us for TradeFinder each and every week as we go through those different scenarios. All right, let's move to stocks of interest. And we're going to go through these rather quickly. Got a lot of them. I just thought I'd update you on a bunch of the ones that are popular. And NVIDIA, we saw the break of 100. And we'd been talking about, there was so many people on the financial networks that said, gosh, if I could get back into NVIDIA at 100, I would buy. Well, they didn't really, because we closed down at 94. So we broke below 100. Maybe we need to come down to this extension on the zigzag pattern. So roughly a 50% correction would yield 100% extension, which happens to coincide in the middle of the tap box for the big wave 5 pattern on NVIDIA. So again, Elliott Wave playing out to a T. Those of you that are newer to Elliott Wave, I invite you to learn more about it. Again, we have tons of information at our website at evotrader.com. It's my favorite of all technical indicators, and we do all that other infusion with AI based now. So we have Elliott Wave. And we have charts infused with AI. I do think we're one of the market leaders because we've been sending out alerts based on this stuff since 2000 or since 2020. So we're one of the early ones in that time frame. But NVIDIA, if you're really aggressive, you can probably go ahead and take a shot because we are oversold from the 10-day moving average. But note that because we broke 100, 100 could act as a little bit of resistance on the way back up. So this might be a short-lived trade or if you're more conservative, you can wait and see, do we actually come down to this 100% level before I dip my toes back in the water on NVIDIA? But NVIDIA looking pretty attractive here with that break below 100. Palantir, go ahead and bring you up the current chart of Palantir because they switched exchanges, as you know. So I'll give you the updated chart with the full data and trying to hit these ones that everybody has been asking about. And there's the big downward move there in Palantir. We said that if it didn't hold this level, that's where the arrow is from where we talked about last week. If we didn't hold this level, we're probably coming down to this next level of support here. And now we have a wave 4 right at 50%. It did hold that bottom. We didn't quite make it to the support level, but we're at a perfect 50% correction in the wave 4. Maybe that holds. We'll see. Don't be surprised if we trickle down a little bit towards 65. But again, if you were really aggressive, maybe take a shot here. We're not quite as oversold on Palantir as we are on some of the other stocks, but we're getting in an area where maybe we come down here and we get more towards the 61.8% wave 4 correction, and you look for something long on Palantir. Y'all ask about Tesla, and again, I invite you to leave comments. We're still going to do the level 3 giveaway. It's just everybody now has access to get a free month of our AI Impulse strategy. But just leave a comment underneath this. Please hit that subscribe button. We are trying to push towards 50,000 subscribers, and we're very close. If you like these, love it if you would smash that subscribe button or hit the like. And if you know anyone that you think, hey, you know, this is pretty cool stuff. They've been pretty accurate. Maybe you want to join them. Would love for you to recommend us to other people as well. But looking at Tesla, now we had Elon come out and say, yeah, he's going to wrap up his stuff with Doge and start to get back. You know, there's been a concern in the Tesla community on the amount of time that he was spending working with the government with the Doge program. On did he really have his eye on the ball? And he said that he's going to wrap that up soon. And we were trying to hold 250. We had this corridor of 200 to 250 in Tesla, which is really important. But we had this triangle. We broke out. We came back, tested the triangle. Classic corrective triangle rules within Elliott Wave. That's what's going to happen. You have the triangle, you break out, you come back and test it. We don't know exactly when. It could be sooner rather than later. But now we're back to testing the point of it. But if you want to be long Tesla, I think you need to wait. I think you need to be cautious and let it get back above that 250 level because we could trade in this range for a while. And if you're wanting to short Tesla, I don't think you do that until you break below this support level. If we break below 200, then maybe you can look for that. Maybe this wave 5 is underway. We don't know that yet because the wave 4 is still green. So the algorithm is telling us, hey, we're not quite sure that wave 4 is done yet. We could rebound. It's kind of a wait and see mode on Tesla at this point in time. But again, to be comfortable being long, you want it back above 250 would be the key. Apple, which I had on the chart for last week and didn't show it. So here we are with Apple. And you've seen all the news headlines, I'm sure, about Apple and all the integration with China and the China tariffs and all that chatter that's been going on. But nonetheless, here is our movement to the downside here. On Apple, and 200 was a key level support. Not only did we break that, but look, on Apple, we actually closed near the low of the day. We are a bit oversold from the 10-day moving average, but that was a little bit of a surprise that we went that far down. Also a zigzag here within the wave 3, just really giving us perfect examples of what we do in our AI-based impulse strategy. So right at the 38.2% level gives you the 61.8. We closed near there yesterday and decided we're just going to go ahead and do the extended wave here on Apple as well. Very similar to the SPY, right down to the 100% extension and being oversold. All these things are showing that we're at least due for some sort of a tradable bounce. Now, y'all ask about SRPT. I tend to try to stay away from these therapeutic stocks because they can come out with any sort of a news item at any point in time and change the pattern. We've had this nice wave 3 to the downside. No zigzag here. This has just been a classic mono impulsive wave. In the wave 3, those are more difficult to figure out where the wave 3 is going to end. When you have a zigzag, at least you have a fib target of where the wave 3 could end. But when you have a mono wave with no zigzag, much harder to figure out where this wave 3 is going to end. We're slightly below the 10-day moving average, but if you're wanting to go long this stock, I think you have to be patient, let it get back above at least the 10-day moving average, and then you may have some time to trade it as we go up and fill this gap, which our AI tells us 94% of gaps get filled. It's not 100%, but most of them get filled. And so I just don't think you need to rush to going long this stock. We are a touch oversold, but let's at least let it get back above the 10-day moving average first before you do anything there. You ask about T, which has been doing well up till today. It kind of succumbed to the selling today as well, which is another reason that when they start selling off, they talk about when the generals fall. So the stocks that have been doing well before the market drops are the ones you want to watch. When even those give up the ghost, that's when you're near a bottom, when people are just washing their hands saying, I'm done with this market. And we're back close to testing that 50-day moving average on AT&T. But I thought I would show you something interesting since you asked about AT&T. Our AI, and this is the AI impulse strategy, the one that you can get 30 days for free right now, had given us this chart on T-Mobile in the same space. And look at that. So we had a target price. Look how great the AI was. Look at how amazing it was. So this is when the signal came out on this day. And then we ran up and hit the target. And look how accurate the AI was. We've tested this AI upward target multiple times. And we couldn't break above it. So if you can't break above resistance, what happens? Eventually you fall back down. And that's what happened with T-Mobile. But we had a really nice bullish trade here in our AI Impulse portfolio based on that. So I just thought I would throw that one in there since you guys had asked about the chart of AT&T. AMD, I know everybody's asking about that. And we used to get that every single week in our insiders meeting, but now it's come back again. We talked about how we needed to hold this 100 level, and if we didn't, it gets a little ugly from there. And we tried really hard to hold 100. We tried it into mid-March. We tried to rally off of it. We ran into resistance. Here I've got the channeling drawn here of support resistance. So we had two levels of resistance. We didn't quite make it to the upper level. Came back down, tested 100 again, and then gave it up with the selling. So once again, you've got a stock breaking a major point of support. We're right in the middle of the tap box. That stands for time and price projection. So maybe we're getting to a point where you can start looking at potentially going long AMD as well, but you didn't want to do it until we bounced off this 100 level. And what I'd commented on is a bounce above 100 was okay, but you needed to see it back above this other point of resistance, and we weren't able to do that. So yeah, we've been pretty darn good, pretty darn accurate on what we've been showing you over the past few weeks. So let's look at NOC. This is Northrop Grumman, a defense contractor, which tends to be an area, especially when President Trump says, yeah, he's anti-war, he doesn't like conflicts, but he does want to strengthen the military. So my first job out of college before I became a golf pro, spent 10 months working in corporate America, was at L3 Harris, which is a sister company to Northrop Grumman. They've both moved to Central Florida with their main headquarters. But as you can see here, even it. So these are signs of the generals giving way. So you had a little bit of move down in the market. You saw that we had some weakening in the economy. Money tends to go into these more defensive-minded stocks, pun intended, defense contractor here, but defense contractors are viewed as being a defensive stock from a sector. And we gave that up today as well, right back down here to the 50-day moving average. We'll see, but you have to be aware that we could come all the way down to 475. That's the next level of support. So maybe the 50-day moving average holds, but don't be surprised if we see 475 over the next week or so on Northrop. But also something that would be interested in to trade moving forward. Microsoft. So a lot of these have potentially oversold bounces, but that's it. They're just bounces when you get oversold from the 10-day moving average. Microsoft, gosh, there's so much news around Microsoft, and we also have the same kind of thing going on as far as news with Google. I don't have Google on the chart this week, but very similar. We tried to hold 375 here at the 100% extension. So we had the 61.8% level. We tested the previous fib level. We came back down. So now we're working on our second level. And not too often do you go to the second C-wave extension on a zigzag pattern, but we're pretty close to that. So I would say we're near a bottom on Microsoft as well. So perhaps at some point in time, we see a tradable bounce, a little bit oversold here. But gosh, did we not nail this downward move? But at this point in time, I think you can start looking to maybe dip your toes in the water long. I know if you're feeling negative about the market, the old Warren Buffett, when there's blood in the streets, that's when you buy. When everyone else is greedy, that's when you sell, et cetera. The famous old quote. We're getting to that point. We had the spike in the VIX that I thought needed yesterday. I didn't think 30 was enough, as you know. But we're starting to get to the point where I think you could nibble on a few of these. But remember, again, they're short-term trades. And I mean by that 1 to 3 days in duration. And then we have to wait and see if this is a more sustainable bounce. I feel like going back to the SPY, that maybe with this ugliness, we might get a little bit of an oversold reflex bounce here. But in the meantime, maybe we need to do some backing and filling before we can mount a real decent movement back to the upside. So maybe we bounce a bit at the beginning of next week, but don't trust that for the long term. We can't have a V bottom, but just with everything that's going on, I think caution still rules the day. Thought I would show you one international chart. We do all the international charts on TradeFinder each and every week, but we had this really classic 5-wave pattern on the INDA. It hadn't really succumb to the selling until today that we've had in the U.S. market. But that wave 4 is purple. So the algorithm is pretty sure that wave 4 is done. So that's confirmed, which means we are in the wave 5. We're moving down. The first step will be to test the point of that breakout of this triangle right here. So a little more downside to go on the INDA. And then we have to wait and see if we do actually move down to a wave 5 low. So be careful on the INDA. Very classic 5-wave pattern to the downside, and also playing in with the zigzag and corrective triangle rules all coming into play here. So thanks for your attention as always. Again, please hit that like button, smash subscribe. Love to get to 50,000, big round number I'd like to see. Thank you for your attention. Have a wonderful weekend. I talked about at the Outlook, somebody commented about that over the last couple of days that, oh gosh, yeah, you said volatility was the one word that you come up with for the outlook for 2025. I think we've satisfied that, but I think we're still going to have some more volatility next week. Hopefully that'll be a little bit more to the upside for your IRAs and 401ks. Thanks for watching. Again, have a wonderful weekend. Look forward to talking again soon. Take care, everybody. If you like these recordings, I'd like to invite you to join our new TradeFinder Live, where each and every week we do a live webinar where we talk about the market, but we also go a little more in depth into the technical analysis system that we utilize to forecast where the market's likely going to go, and also to identify trading opportunities. Get your free subscription today. Take care, everybody.